Hey guys, Kyle Thompson here with Throssmyhr Real Estate Group, and today I'm going to be doing a video on mortgage basics. Most often when people buy property, they need a mortgage in order to do so. However, I find that a lot of the time, people don't even understand the basic components of what make up a mortgage or the differences between them. So in today's video, I'm going to be breaking down the components of a mortgage, what are some of the different variables, as well as things that you can do to make sure that you get the right mortgage for your specific situation. First things first, you need to go get pre-approved. That means talking to a bank or a mortgage broker to determine what it is that you can afford. For most people, I suggest going with a mortgage broker as they shop you around to different lenders and can often get you more favorable terms or a better rate. That won't always be the case though, especially if you have complicated financing or you're self-employed. Then in that case, it might be better to go with your bank as they have a better idea of what your net worth is. In other circumstances, like if you're trying to buy a mobile home in a mobile home park, then you'll probably want to go with RBC or a credit union, as those are the companies most likely to lend on those types of properties. Now, when it comes to the pre-approval, there are two different kinds. There's a fully underwritten one and a non-fully underwritten one. What you want to get is the fully underwritten pre-approval. How this works is you go talk to a mortgage specialist and they'll collect all of your personal details like income statements, job letter, and tax return, and then they'll send that info away to go get pre-approved in advance, and you'll get a real number for what it is that you can afford. Now, something I want to point out is that just because you're approved for $750,000 doesn't mean you can go buy any property for $750,000. The property itself is the collateral that the bank will use against the loan, so they need to make sure that they'll get their money back out of the property in the event that you default. First up, we have the loan amount and down payment. The loan amount is simple. You simply take the purchase price of the property and you minus the down payment. As for the down payment, that'll depend on the purchase price of the property. Minimum down payment is 5% on the first $500,000, 10% on the portion between $500,000 and $1 million. Any properties over $1 million are a flat 20%. Just to make sure that this is nice and clear, for a $750,000 home, the minimum down payment would be $50,000. 5% on the first $500,000, so $25,000, and then 10% for the portion between $500,000 and $750,000, so an additional $25,000. Now, if you're putting less than 20% down, then you're going to get what is called an insured mortgage. Insurance is for the lender, not for you. It's actually mortgage default insurance, and this insurance comes at a cost. I crunched the numbers online, and for a $750,000 house with a minimum down payment, default insurance will cost about $28,000 throughout the lifetime of the loan. Fortunately, the cost of the insurance is just rolled into your monthly payment, so the pain is spaced out over time. Next up, we have the amortization period. The amortization period is just the total length of time that it will take you to pay off your loan. If you have an uninsured mortgage, you can amortize your property to 30 years, and if you have an insured mortgage, you can amortize it up to 25 years. Obviously, the longer the amortization period, the lower your monthly payment. In some places, like the United States, for example, you can get a 30-year mortgage with a constant rate all the way through. This is not how it works here in Canada. Here, we break them up into smaller chunks called terms. Most often, we go with 5-year terms. After your term is up, you'll need to renegotiate a new term at a new rate. That brings me to fixed versus variable rates. Let's start off with fixed. A fixed rate is exactly what it sounds like. It's just a rate that remains constant throughout your term. That means your payment doesn't change even if the prevailing rates do. The advantage of this is that you're protected against rising interest rates. However, this advantage comes at a cost. Fixed rates are typically higher than variable rates, and the penalty for getting out of your mortgage early, it will be higher. When it comes to variable rates, what you're doing is you're locking into a discount below the prime rate. As the prime rate fluctuates, so will your rate. And there's two different ways that you can deal with this. There's an adjustable rate mortgage. With these, as the prime rate fluctuates, so does your payment. Then there's the variable rate mortgage. With a variable rate, what happens is as the rate goes up, your amortization period gets longer, and if rates come down, your amortization period gets shorter. Either way, your payment remains constant. Finally, we have payment frequency, and there are a number of options. There's monthly, semi-monthly, bi-weekly, or weekly. When it comes to regular payments, the frequency doesn't really matter all that much. It mostly comes down to a personal preference. Now, there might be a very slight advantage to doing a more frequent payment, depending on how your lender calculates the interest, but the difference is so small that it's almost negligible. There's also an option to do what's called accelerated payments, but these can only be done bi-weekly or weekly. How these work is each payment is slightly higher than it normally would be, the net effect being that you end up paying the equivalent of 13 monthly payments throughout the year. While this might not sound like a lot, if done through the duration of your loan, you could end up paying your loan off years earlier and saving yourself tens of thousands of dollars in interest in the process. I'll put a link for a mortgage calculator in the description below so that you can crunch the numbers yourself and see if accelerated payments might be an option that you want to explore. Those are the basic components that make up a mortgage. Now, there are other factors to take into account, like is the mortgage open or closed, is it assumable, or is it portable? These factors can affect the interest rate, but it might end up saving you money in the long run. So getting the lowest rate might not actually be in your best interest. I have included a free downloadable PDF that has all the questions that you'll need to ask your mortgage specialist to make sure that you get the right mortgage for your specific situation. I really hope that you got some value out of this video. If you did, please consider liking and subscribing to our YouTube channel. And finally, if there's any real estate related topics that you feel like you don't understand or you would like an explainer video done on, please leave your suggestions in the comment section below and I'll get to them as soon as I am able. Thanks for watching.